Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Well, Art Jarvis, welcome back for this edition of Taking Stock. It's good to have you as you travel the roadways and the byways all across America. Good to have you on the phone for this edition of Taking Stock. How is it going? And then let's get into what's happening in the economic world.
Yeah, it's great to be back. Thanks for having me again. And things are great. I'm doing what I call my out west tour, visiting clients and things, and if you haven't had the opportunity to go out west in the United States, I highly recommend it. It's a beautiful part of the country. It's a beautiful part of the world. So I'm currently in Colorado, and it's absolutely beautiful here right now. Not to rub it in.
Well, before we got going officially with Taking Stock, as I mentioned, I'm looking at beautiful blue sky and sunshine over lovely Loveland as we speak. So, we're a little jealous that you get to do the out west tour right now, but it's a beautiful day here as we get started with this edition of Taking Stock. So what I was going to ask, just for the fun of it, is, so does the economy look any different when you're traveling through Colorado and out west?
Yeah, things are a little more spread out west, let's put it that way. So it's less crowded unless you're in Dallas, Texas, where things are still bustling. Let's be clear about that. The one thing that is maybe of some interest to me is, the number of trucks that are on the highway. There is in my opinion, a market increase in the number of trucks traveling our highways. To use a technical term, it's a bunch.
Well, we are going to have to look that up. I'm writing it down for future reference. It's a bunch.
Sometimes want to use too high-tech terms on you, but it's very. The highways are full of tractor trailers, and you see trains, and the restaurants are busy and things like that. So, if you're kind of looking for how's the economy doing in general, there's nothing to say to me that things have slowed down in any way, shape, or form, and that's reflected in the numbers too. So, I guess that's one positive, it's like I said, it's been a good trip, and there's been a number of things that have stuck out to me that keeps me on the positive path. Let's put it that way.
Outstanding. Well, and I hate to be the one that takes you off the positive path, so hopefully this won't lead us off the positive path. But I know, you've been talking about it on the last 2 or 3 versions of Taking Stock, episodes of Taking Stock, if you will. That is that, we didn't want to go too far, too fast with the growth, with whatever's happening economic growth-wise. And I guess, so it's not negative news. You're saying we are experiencing a little bit of a pullback, which is a good thing, yes?
Most definitely, yeah. The indices in the last couple of weeks have pulled back anywhere from 1.5% to 2.5%. 1.5% being more for the large size companies, and 2.5% being for the more smaller size or tech companies, which makes perfect sense because, as we talked about weighted and unweighted indexes, it was really the small size companies that were leading the way. So, but yeah, too far, too fast, and then especially sitting here in August, I look at this as a perfectly normal and healthy pullback, especially when you couple the pullback with some good economic numbers. The inflation numbers have continued to come down. We're at 3.2% now on the consumer price index. So, I know the Fed is shooting for 2%, but many of the things I calculate and projections I try to do are based on 3% inflation. So I'm happy to see being back down to 3% inflation.
You're right in the neighborhood where you like it.
Yeah, and we'll talk about this here, I'm assuming here in the next few minutes, but that doesn't mean that our cost of goods and the things that we need to purchase and the things we need to do to live our lives have declined. Okay, that just means the prices are not growing as fast as they were a year ago. So there's good in that, and there's the not so good in that. But the thing is always, what impact does that have on the consumer? Because the consumer is, basically about 70% of its gross domestic product, and retail sales were better than expected last month, and that's a good sign that the consumer is still in there. And if you have to look on the negative side, we have had increased interest rates, and we've had now mortgages are starting to go up. Excuse me, and so now you're starting to see a decline in some of the new home starts, and you're also starting to see more new mortgages declining. So, which makes perfect sense. It's now we're at 7-point-something% on a 30-year mortgage. So so there's that. We talk about, I always use the cheeseburger as the example. The cheeseburger went from $5 to $7.50 last year. Probably not that much. The fact that our inflation is still growing at 3% or 3.2% means that the price of that cheeseburger is still going up. It's just not going up as fast.
Shoot, I was hoping that with the inflation rate down, increasing more slowly, that maybe that cheeseburger would hold steady at $7.50. No, probably not. And then also it's what are the employee wages and things like that. Sure.
So do they have to pass on costs and things like that? There's disinflation, which is when it's kind of a temporary slowing of price increases. It's slowed down, which is kind of where we're heading now. It's a positive thing, but there's also deflation, which is a general decline in prices. So it sounds like that would be a good thing, but some pretty nasty or bad things have to be happening, and probably are happening in the economy to cause those prices to start declining. So, and I don't think we haven't seen deflation in decades. So, but bad thing, I guess if I had to pick a cheeseburger that was 3% higher, or I had to pick something going bad in the economy, I think I would still take the 3% increase in my cheeseburger.
Well, hopefully it all relates, because if the cheeseburger price is going up a little bit, hopefully there's an inflatable number in our earnings as well as individuals, so we can absorb that. We just don't want to fall behind. Let's call it that 3.2% inflation rate. Hopefully, individuals like you and like me can continue to earn higher numbers as well for our own personal earnings, and out earn the inflation rate is, I guess that's the goal, right?
Yeah, sure is, and that is the other thing. There's a number of people that saw in the last 2 or 3 years have seen a substantial increase in what they make, what they bring home. It's if you go to a fast food worker or something like that, whereas that person may have been making $8 a couple years ago, and now that person's making $13, $14, $15 an hour. So that from that standpoint, you've seen a substantial increase. But I think you've also, the majority of people have seen an increase in their salaries and their pay over the last couple of years.
Yeah. Well, again, as long as the wage and salaries, outgain the inflation rate, or at least keep up with it, it feels a little less painful
That's correct.
individually. So, hey, you touched on something when you were talking about the increase in interest rates and how that affects the mortgage rates and the purchasing of homes. What about new home starts? Is that a number that's still going up? Is that still a positive sign, or what's happening in that respect versus just the home sales marketplace?
Yeah, I think again, I tend to look at the trend, so I'll look at a 3 to 6 month trend or whatever. But so yeah, the trend in new homes, it's still up.
Yeah.
So that's a positive. But this most recent home sales or new home starts number was definitely less than expected, and it was negative. So that's one data point on that graph, right? So but you have the shock. Some people have 3% mortgage. Some people have less than 3% mortgages from the last few years, and then all of a sudden we shoot up to 7%. So there is some shock there, but it's also kind of a relative number. 7% definitely increases your monthly expenses when it comes to that. What may have been $1,000 mortgage a couple of years ago at 3%, now it might be a $2,000 to $2,500 mortgage at 7%. So yeah, it definitely kind of changes your monthly budget. There's no doubt about that.
Right.
But at the same time, our parents, their mortgage rates were 15, 16%. So, or maybe even higher. So, on a relative term, is 7% higher than 3? Yes, but it's not 15 and 16 either.
Right. Well, no, and you say that, and I can recall my parents being, I'll use the word flabbergasted as mortgage rates rose, at times. Now, thankfully, they were sitting in a home and not worrying about an increasing mortgage rate, but I remember them talking about the 13s and the 15%, and oh my gosh,
Right.
Now for the young adults who are listening, your parents were seeing those 7 and 8%. They weren't seeing the 15 and 16 that Art and Chuck's parents were seeing. But still, again, like you said, there's a shock value that obviously does slow the market. One of the things that I scratch my head at, and I don't know if you can lend insight to this, but and yes, pun intended with a lend insight to this. Folks, but anyway, yeah, sometimes I think I'm fancy with my words,
There you go.
Yeah, so much for that. Anyway, the question that I'm wondering if you can lend insight. So, the real estate market, as we know, was just like unbelievable is probably too simple a word to use. You put your house on the market over the last 12, 18 months. I know there was a slow in there a little bit, but maybe even over the last 2 years, you put your house on the market with that, hey, coming soon, and schedule a walkthrough, a showing, and then you had multiple offers, within, immediately as soon as you literally put the house on the market, and it's sold and gone. But here's what I want to know if you can lend some insight to, because we're talking about the mortgage rates and the lending rates. People were saying, I'm going to buy it and pay cash, and they were paying above asking price. There was bidding wars going on. How does that translate now to a slowed market because of the mortgage rates? If people were paying, I'm going to pay you cash, and paying, and getting in bidding wars above the ask price. Do you have any idea how that works? Because I don't.
Well, I mean, number one, two things. Your higher interest rates. So, so let's say you're not paying cash. You're at 7%. Also, as you said, it's definitely been a seller's market here for quite some time. And, sellers can pretty much ask for whatever they want, and buyers are willing to give up many things just to try and get into a house. But, you have property values or home values that have increased 20-30% depending on where you are in the country, and you have mortgage rates that went from 3 to 7%. So that's a big number. That if you were paying whatever $1,500 a month for rent, and then all of a sudden you ran out to look to buy a house, you're not. Again, I'll say, well, you're not paying that $1,000 mortgage anymore. You're paying that $2,000 plus mortgage. So that's a much bigger number coming out of your monthly budget. But I think with the paying cash and things like that, I think the hope is that many people, I think it's a possibility over the next 12 to 18 months that you actually start to see interest rates start to come back down a little bit. So hopefully what they're able to do is, change that number and, alleviate a little bit of that burden that they have on a monthly basis when it comes to their home sales. But there was definitely a paradigm shift in the last 3 years. People were happy being in an apartment, especially some of the younger crowd was happy being in an apartment. But then COVID hit, and we're spending a lot more time in our homes. And, maybe sitting in that apartment all day didn't sound too appealing. So all of a sudden you had this huge rush in of demand for homes. And it's the same for people who've been still own homes. They started increasing the size of their homes. They started changing the complexion of their homes. So there was a lot of money spent there. But yeah, all of a sudden you had this huge demand and not a whole lot of supply. So if you were a home seller, you were in the catbird seat, that's for sure. There were people, as you said, paying tens and tens of thousands of dollars over asking price, not doing inspections and things like that. So
right.
I can't wait to see here in the near future where people who did not have inspections on these homes that they paid a premium for start to find out where the problems might lie.
Yes. Well, and and some of that question, I realize as we talk through it right now, Art, some of that question is probably better aimed at a realtor, maybe even some of the mortgage lenders to talk about some of that. But I appreciate the insight that you're able to share and and help people understand what is happening in that part of the money, in that part of the money market, as I say there. A lot of the things we're talking about add up to, at the end of the day, how people feel with their personal finances and, their personal financial future, which is what, Jarvis Global Investments is all about, is helping people with their, personal finances and their personal financial future. One of the things that comes from that, Art, that we sort of back off and don't talk about too much, but I did want to touch on today, which is everybody likes to blame politics and blame, either the past administration or the current administration. And you've been sharing some of the economic numbers, and I'll say in the political world, we hear those numbers spun to favor, and the funny thing is, each party will spin them to favor their narrative, I guess is the word we like to use these days. But how, in real numbers from somebody that works in the financial world as you do, and is trying to help your clients, wade through the waters of finance and the economy, what do the numbers really look like right now in the current administration, and how does that compare to the previous administration factually? What can you tell us on that?
Well, I mean, if you look at growth if I'm going to go with right before COVID, heading into 2020, we had basically 3% unemployment. Now we're back down to 3-point-something% unemployment. But, at one point we were probably at 20% unemployment. So, we've worked our way back from that. If you look at gross domestic product, we were clicking along at a very nice 3-point-something% rate per year. Now we're at 2 point something, 2.4 I think is the number for the second quarter, and we're at about 2% year over year if you look at the first quarter of this year. So that has come down substantially. And then again, when you hit 2020 was again a 100-year occurrence. I mean, someone flipped a switch in March of 2020, and with the gross domestic product or the world economy dropped 35-45%, and then that's substantial. So that was painful, and we're still recovering from that. You look at supply chains and things like that. I always try to use the analogy that the supply chain should be a gentle wave in and out. People need stuff is shipped in, there's more orders go out. When it kind of is a gentle, it became a tsunami in 2020 because, number one, it got completely shut off, and then when we finally did start making goods again, and it got started, people are ordering way more than what they need. So, now instead of being this gentle wave, it's a big wave crashing in, and then you can't get the goods again, and then finally so it's that is still a problem, and honestly, that's probably another couple years of working itself out if things go well. You look at prices again. We are. It's always interesting to me that gas prices got up to 4 point something, and then you start to hear the spin that how great things are because we're down in the $3 range for gas, and how happy I should be. Well, guess what? I'm not. Compared to the rest of the world, $3 gas prices is not bad, but it's definitely higher than it used to be. We had 9 or 10% inflation last year. Well, and now we're down to 3%. But as we were talking before, that cheeseburger, or when I go to the grocery store or something like that, those price increases over the last 18 months or whatever, those aren't going away. Those price increases are there. And honestly, unless something bad happens in the world and we see a whole lot of money pulled out of the economy or something, those prices are probably generally going to stay there. So, I guess if I'm answering now that I've long-winded answer your question, if I look at where we are today compared to where we were 3 years ago, we are not in as good of a place as we were 3 years ago.
Well, and that's the key, because I think if you listen to the political rhetoric, it's almost a slap in the face when you are feeling the real finances in your own home, whoever you are, me, you, or any of our friends and acquaintances. And it's hard sometimes when you hear the political rhetoric that's reported, and again, I don't want to, I'm a part of the media, but we all refer to, how the media reports it. And it's, again, a slap in the face when they say, oh, this is good, and this is good, and this is better, and this is better, when in fact we know it's like, okay, gas is down to $3.49 a gallon, but we were paying under $2 a gallon just to use the gasoline. And then, of course, we can always go back to your cheeseburger analogy. The cheeseburger's not $5 anymore. The gas isn't $1.79 a gallon anymore, or whatever it got down to. So the real news is in the past, now 3 years, if we go back to that, like 2020, things have gone up. And while, again, the bad numbers went up, the unemployment, as you said, rose even as high as 20%. The gross domestic product went down, things like that. While the numbers are going in the right direction now, that's the question. Will they get back to where we were? But the reality is they aren't there. And when you're feeling that pain, it's real, and don't be confused by reports that are spinning, how good things are now, because it's not where it was in 2020, 2019, 2018, whatever. So, and I don't know, and I'm not trying to lay it on administrations, because policies and things carry over and take time for the cause and effect. But it's just the narrative and the spinning that happens, by the people directly involved in that political rhetoric. It's tough sometimes to hear, and I think everybody needs to know the reality. Even here, listening to Taking Stock, because I think we together, Art, try to share something people can look forward to and feel the hope in, and not be negative. So, the positive is good and the positive is real, but don't scratch your head and say, well, how come I'm still suffering? And,
right.
What is it, just me? No, that's the way it really is, right?
Yeah, right. So certainly, monthly budgets definitely have had a strain put on them. And, you can tell someone how much better things are, but then they look at their monthly budget and go, well, not seeing it on this end. I'm still spending this much extra on this area and this much extra in that area. So, and it's interesting, there's the psychology of the markets. And, if this was strictly a numbers business, I probably wouldn't have a job. Everybody would be doing it. But, it's always the psychology. And behavioral finance. The one thing I think, if I look back at my college experience and then my education, is there was a lack of education and classes on what I call behavioral finance. And that's what, behavioral finance is what makes this world tick. Okay? So every administration is guilty of it. They put their own spin on whatever's going on at the moment, right? And some people, they bite on it. I get told how much better things are, and yes, things are better, but I'm not really seeing it. But at the same time, there's a psychological reaction when someone's telling you things are better and things like that. Because we've talked about the Fed, and they can manipulate interest rates just by talking. If I'm a consumer, and I have the people who are leading the country and telling me that things are better, and we're not heading into a recession, that's going to make me more positive about the future, and potentially spend money on things that I might not spend money on if I'm more nervous about the future. And there's indicators. There's consumer spending indicators. There's consumer confidence indicators and things like that. That's why we keep an eye on those things. How do people feel right now, and how do they feel about the future?
Right.
But if you look at those, those are into consumer confidence numbers have been improving, but they're still a lot lower than what they were back in 2019 or so.
Yeah. Well, and transitioning from that to closing this edition of Taking Stock on a high note, I know, I guess what we can find hope in is that I think the report on retail sales, what's that indicator showing us right now?
It's better than expected. So that means people are still out there. Again, if I'm looking at consumers being 70% of gross domestic product, that tells me, number one, not only are they out there continuing to spend, but they're also spending at a higher level than what we're predicting. So, again, that's last month's report, and we'll see what next month's report, that's one data point on that graph, but it's not showing any signs of slowing down. But the other argument is we pumped $6 or $7 trillion into this market back in 2020 and 2021. The big concern, and what to kind of watch it now, is that money, that extra money, beginning to dry up.
Right.
And if it's starting to dry up, what impact does that have on the consumer? Does the consumer start to slow down and things like that? And it brought up another thought real quick, and then let's just close. But, we talked about it before. Our national debt now is almost $32 trillion. Our cost of debt, because of inflation and because of higher interest rates, is going up. Whereas if we only had 2 or 3% inflation and we had lower interest rates, our ability to fund our national debt and what we paid on interest wise on our debt was much lower 2 or 3 years ago. Now we're at 5 or 6 or 7% interest rates, and as we go to refund or refinance that debt or put new debt out there, that our cost of doing business, our interest cost on that debt has grown substantially, and all that's going to do is cause that debt to continue to rise even more than it would have. So that's another negative if you want to look at things from today to 3 years ago.
Excellent. And that'll be the transition when we come back with our next edition of Taking Stock. We can maybe dive a little deeper into, what the national debt means to the consumer, and what kind of advice, general advice, do we pass along to people to best, again, wade through those economic waters. So Art Jarvis, listen, thank you once again. I know you're on the road out west and hopefully enjoying that great out west weather that you were talking about, but also I know you're working and visiting clients and helping people, again, wade through the economic waters. But thank you once again for joining us with Taking Stock, and we look forward to the next edition.
As always, a pleasure, and thanks for having me. Hope you have a great day.
All right. Thanks, Art. Take care.
Thanks, Chuck. Bye-bye.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.